Good afternoon, my family, my people, my Wealth Our Way village, tribe, nation, whatever we go by, it's what we're doing right here at Wealth Our Way, where it is our lifelong mission to show the entire world that wealth is not only for the wealthy. I'm your man, Charles Tank Harris, Chief Visionary Officer and founder of the financial literacy platform Wealth Our Way. You already know what it is. Today is Wednesday, March 31st. It's the end of the first quarter of 2021. Yesterday, we wrapped up the 14-day wild financial fast, and we're about to move into quarter two with some momentum and some energy. And I want to thank every single one of you that are here right now, tuned in to the live broadcast, whether it's on Facebook or YouTube. And I got to salute and shout out my overnight family, my pre-record watchers who do it on a lunch break in the bathroom while they're cooking, whatever they can get it in. They squeeze 15 minutes of financial literacy in with your boy. So I love it. And don't get it twisted. I'm not just doing this at 12:30 Eastern time every day anymore. I'm 6:30 at night in Clubhouse. You don't get to see my pretty face, but you hear my voice giving this financial literacy every weeknight at 6:30 Eastern Daylight Time. Tonight's topic is going to be crazy. Tonight's topic, we are talking about credit cards versus debit cards. We're talking about 3 reasons why you should never use a debit card ever again. And if you check on the Wealth Our Way page on Facebook, you'll see a video that I posted of a gentleman, Edwin something or another, who just gives like a nice little 4-minute explanation as to why using a debit card is the devil's work and you should only use credit cards. And for my family across the nation who says, Big Tank, I can't get a credit card. Credit score is -60. No one hollers at me on that. We're going to talk about how to get you a credit card, build it up for you. We're going to also talk about things that we've mentioned in the past, building up our children's credit score so they come into the game ready for war. Now, I have to be responsible when I talk about credit. So your man Big Tank is always going to be a bit of a double-edged sword. I'm not the cat that's telling you to go out there and get all this credit, run up this amazing high numbers of debt, and never be able to get out of it. I will never send you out to war with a Uzi without the proper training on how to use that piece. Not supporting gun violence. Let's be clear on that. So with that being said, I want to talk about the reasons you ever choose to use credit cards in the first place. So when you come and follow Wealth Our Way, you get all of the information, not just part. I'm not trying to keep you on the hook so I can sell you something later. I'm here to tell you what it is. I'm not here to sell you. I'm here to tell you. So with that in mind, we're going to talk about what we're talking about today on the noon edition of 15 Minutes of Finance. So let me give you a little background on me. Most of you guys are family. Y'all know who I am, what I do. I'm a 24-year veteran of the financial services industry. Got my start way back in 1997 with the firm Smith Barney, right as it became Solomon Smith Barney, right as it went from Citibank to Citigroup when Citibank and Travelers merged. I then went to Payne Weber as it became UBS, United Bank of Switzerland. I've been in the game for a very long time. I've launched firms of my own, Athletic Business Management, the Sports and Entertainment Financial Group. I've spent some time in the insurance industry at Define New York Life Insurance Company as an investment advisor under NyLife Securities. And now I come to you with this financial literacy platform, Wealth Our Way. One of the main reasons I transitioned from institution to my own practice is for freedom. I can pop the collar on the shirt that I want to wear, where I want to wear it. I can show up whenever I want to show up, talk about whatever I want to talk about. When you are kind of handcuffed because you're got a compliance department making sure you don't say anything that they can get sued for, you got to kind of watch what you say. And then also you're also pigeonholed into selling things. And I don't want to sell things to people. I want to improve people's financial life. So that's why I'm here. But one thing that I did learn working at these big practices, especially when it came to selling, is that there are 2 things that always are at the heart of anything that gets sold. I give you a second to put in the chat. Anybody who puts in the chat successfully will get 50% off the next webinar I throw. What 2 things do marketing and advertising specialists always come at you with to try to sell you on something? It's 2 things. It's as old as time itself. Give you a second. Your second's up. So the two things are sex and fear. Those are the two major motivators that make people take action: sex and fear. I don't care what type of commercial you're looking at. I promise you, steer hard enough, listen well enough, and you will see where there was sex or fear, sometimes both, in that commercial to prompt you to act. I will not manipulate you. I will not come at you with sex or fear to try to get you to take action. I'm going to give you the real. If you don't want to take action on it, don't take action on it. But I'm going to give you the real. I had to come with that precursor because what I'm sharing with you today may scare you. And it's not intended to scare you to make you buy something, because you will see by the time this is over, I'm not going to ask you to buy anything. What I will say is, though, before I scare you to death, you see the banner rolling across the bottom. You better have this book by now. The book is like $7, I think, $6.99, $7.99. I don't know what it is. You don't have this book, but you call me, inbox me, or email me for information, I'm gonna choke you. Get the damn book. The book has so much information in it. It's very helpful. It'll answer all your questions. You don't have to hear me be long-winded when you call me. Just get the book. But anyway, that's not what we're talking about today. We are talking about today the impending financial crisis that is going to affect not only this, not only you, not only everybody you know, but not only the entire country, but the entire globe. This next financial crisis, like so many that have preceded it, is coming. It's coming like soon, and it's going to be the worst we've seen yet. So there's the bad news. I don't have no music playing in the background. I might be big enough to play Godzilla or something. I don't have any monsters lurking around. But when I tell you this thing is real and it's coming, that's the bad news. What's the good news? The good news is we've seen them before. We've survived them before. We will survive this one. It will not feel like we're going to survive it while it's happening, but we'll get through it. I want to prepare my people, you, for what's coming and get you ready. I'm actually super excited about this situation that's going to occur. So let's talk about what's going to occur. We are going to have widespread financial crises in every major market. We're going to have it in the currency market. We're going to have it in the bond market. We're going to have it in the commodities markets. We're going to have it in the stock market. We will also have it in the cryptocurrency market. Why is this going to happen? It's going to happen because all of the economic fundamentals of the leading economy in the world are effed up. You almost got me. It's effed up. Right now, let's talk to you about a very simple measurement tool that professionals use to look at the stock market. So right now, for purposes of this conversation, when I say stock market, I am talking about the S&P 500, Standard & Poor's 500. It's the 500 largest companies in America. 500 companies in America, okay? The S&P 500, it shows it every day on MSNBC, CNN, what the little ticker in the bottom right-hand corner, going up and down, going up and down. It is a broad-based market. 500 is a lot of companies. There's also the Dow Jones Industrial Average, but that's only 30 companies. So we don't use the Dow, even though you'll see that one listed as well. We normally refer to the S&P 500 because it's a broader base. I went to school for actuarial science and finance. They teach you in math and statistics. The larger the sample, the more accurate the information. So the S&P gives you a better accurate picture than the Dow. Historically, when we want to talk about how much the market costs, we are talking about a ratio called the price to earnings ratio, the PE ratio. This is one of the biggest things that I teach when I'm teaching beginner investment courses. People look at stock prices and they see whatever the share of stock costs, and they think that's the price of the stock or the cost of the stock. Well, you have to delineate. There's a difference between price and cost. Price is that number that's going across the bottom. $78 a share, you're writing a check for $78. The actual cost is different, though. When you think about what something costs, you're thinking about something in totality, not just a price tag that you're paying. And if I charged you $78 for a stock that is paying a $10 dividend every year, you know that in 7 years, should the dividend stay the same, you're getting almost all your money back. But if I charge you $78 for a stock that pays zero dividend, things stay the same, you're getting nothing back. Which one has a total cost that's higher? You would have to say the one that's not giving you a dividend. You see no way to recoup. Well, when you talk about the price to earnings of the stock market, you are looking at all 500 companies put together. You're dividing those prices that we talked about by the actual earnings we expect the company, the whole stock market to make. Earnings are what they do when they look at what a company sold. They take out all of the cost that the company had to do to sell those things. They have their net earnings. Then they take the number of shares that are outstanding for the company and they divide it into that number. And that's how you get the earnings per share. I'll do all of this on a whiteboard at some point so you guys can see the numbers. Well, if you can do earnings per share for a company, it's simple math to add all 500 together and divide by 500 to get the earnings per share for the entire market. We measure that ratio. And when it's high, we say the market's expensive and we should kind of stay away from it. When it's low, we say the market's on sale and we should be putting more money in the market. My statement to you is, what determines high versus low? Well, let's go back to my math background and say it's an average. We can look back almost 200 years. The market goes back to like 1871 or something crazy. So 150 years. And we can see historically what that average number is for the price to earnings ratio for the market. I'm here to tell you that the average number is somewhere around 21, 22. That's the average. When we see the market trading significantly higher than that average, normally a crash is coming. What is a crash, Big Tank? A crash is when the market goes down precipitously, that means very quickly, over 20%. I like to use 30%, but 20% or more is considered a correction / crash. It depends on who you're talking to. The difference between a crash and a bear market is a crash is quick and you can recover sometimes very quickly. A bear market is when the market crashes or corrects or stays flat for an elongated period of time. You'll hear, if you study investments, you'll hear about the lost decade of investments from 1999 to 2009, that 10-year period. The S&P 500 returned -2%. So for 10 years, if you had your money in the stock market, you lost 2%. And that was with reinvesting your dividends and capital gains. So we had a whole decade where you made no money. If you put your money in on January 1st, 1999 and took it out on December 31st, 2009, you made no money. You lost 2%. We are in store for one of the biggest corrections and prolonged bear markets in history. I'm going to be talking about this today, tomorrow, and Friday, prepping you for what to do. Here's why I'm excited. When somebody has money and something bad happens, what happens to that person? They lose money because they have it. When you don't have a lot of money and something bad happens in the financial markets, what happens? It doesn't affect you that much. I grew up relatively poor. I grew up in the crash of 87. My people weren't affected. We didn't have any money in the market. I say that to say that my audience, the people that I talk to, below middle income to middle income to the highest of middle income, but not ultra wealthy, this is an opportunity like you have never seen before. We talk about closing the racial wealth gap. We talk about taking the distribution of wealth from the 1% to the 99%. There will never be a better time, probably while we're alive, than what's upcoming to do that. So I did a really good job today of giving a little teaser to hopefully make you come back tomorrow so we can get into the nuts and bolts of this, where I talk real numbers and have some slides. But doom is on the way, but hope is here to stay. I just made that up. Somebody write that down. We want to keep it rolling. I want you guys back tomorrow so we can talk in detail about what's coming up, how to protect yourself, how to make it through here better off than you went into it. My name's Charles Tank Harris. Wealth Our Way believes wealth is not only for the wealthy. You got to get on board with that mindset. Have a great day. I'll talk to you tomorrow. Take care.